Yesterday was a reversal day and it had 3 pushes up, spike, second push, third push. You expect 2 legs down, maybe 1 pullback, 2, maybe a little bit more. Whenever you have a reversal day, you have a big down, big up situation, and that creates big confusion and usually leads to a trading range. Daily chart, even though it's a parabolic wedge, 1, 2, 3, or 1, 2, 3, or 1, 2, 3, which is climactic, it's a tight bull channel, and tight bull trends usually do not reverse into bear trends. They have to go sideways first. And, we had a big doji bar yesterday, and that's a sign of neutrality. It followed 2 other doji bars. Back here, we had a big doji bar after a rally. It went sideways and then pulled back. And then a big doji bar here after a rally and pulled back. And I think we're going to pull back. We're in a channel. We've had 5 pushes up, 1, 2, 3, 4, 5. And when you're in a channel, you break to the upside and then go sideways and then pull back. Break to the upside, sideways, pull back. Break to the upside, sideways, pull back. Break to the upside, sideways, probably pull back. Also, we've been trying to get above 2,500 for a couple months, and we finally get above it. However, we're not racing upward. We have bull bars. In fact, we have 8 bull bars, but they're not big, and they're sideways instead of consecutive big bull bars with very little overlap. It's not like this where there's very little overlap. There's a lot of overlap. So I think we're starting to do this or this, and I don't know if it'll last for a week or a month, but I think we'll test down. When we tested down this time, we get very close to the prior low, much closer than we did here or here, and that increases the chances that when we test down this time, we'll get down to the low or below it. That's about 100 points down. We might get all the way down to the bottom of the channel, but if we do, it'll probably take many months. Monthly chart, 11 months without a pullback. Every low at or above the low of the prior month. Really, really unusual. And therefore, the odds are it'll end this month or next month. In other words, either this month goes below last month's low, not likely since we are 2/3 through the month and we're at the high, or next month goes below this month's low, or the following month goes below that low. But sometime in the next couple of months, 2 or 3 months, we should get a bar that trades below the low of the prior bar. It's climactic, but it's also a sign of very strong bulls. And therefore, if we get a reversal, even if it's a big reversal like this one, it'll probably be brief and only last a bar or 2, maybe 3. In other words, 1, 2, or 3 months. Probably the best the bears can get is a pullback here. We have a spike pullback channel, and that would be about a 200-point correction. It would be a minor correction on the monthly chart, just like this and this and this. Those are brief, 1 bar, 2 bars. However, on the daily chart, it would look scary. We finished yesterday with a strong rally, and therefore always in long. However, we failed to get above the highs. And whenever you have a reversal, the odds are you go sideways and rather than continuing up. So today has an increased chance of being a trading range day. You can see on the daily chart, we have an outside day yesterday that increases the chances. Today will be an inside day. An inside day means today a rally will not get above yesterday's high and a sell-off will not get below yesterday's low. If today is going to be an inside day, usually the market tests one way early on and then reverses for the next several hours. And since we're close to yesterday's high, we're always in long, and yesterday had pretty good momentum up. If we're going to test yesterday's high or low, we probably will test yesterday's high first. So we have a pullback. We have a double bottom 75. And we have two legs down, one pullback, two, but it's a doji bar, tail on top. It's actually interesting right here. You know, you could sell the one high, you could sell 1 point above one and put a stop above yesterday's high. At this moment, you'd probably have better than a 30% chance of having a profitable trade. Let's say we rally a point or 2 points. You know, the math becomes really interesting. Today's going to try to be a doji day. We had 3 doji days, especially the past 2. That increases the chances of more trading range trading. Yesterday we had a very big day, and we're opening within yesterday's range. That increases the chances of a day that stays inside of yesterday's range. Bad looking stop order bar. It's a trading range bar. Over the past 10 bars, big up, big down, big confusion, probably a trading range based upon these 10 bars, and then based upon the entire reversal, probably a trading range. We're just above the 60-minute moving average. We have a bull body on 1, a big tail below. This is a low probability sell. First bar of the day, without knowing anything about it or anything about the context, there's a 20% chance it's the high of the day or the low of the day. Here, probably buyers below. We have a spike pullback channel. Very often, when you get the reversal, it goes sideways for a number of bars. The bulls hope for a double bottom with the second pullback, first pullback, second pullback, and trend resumption up. And the bears want the market to get down to the beginning of the channel, down here. Now, I was talking and I was too slow. I tried to buy 7 ticks below the 1 low, and I did not. The reason why 7 ticks is a lot of traders will try to buy 1 or 2 points below 1, and you know, I'm not confident that we're going to go down all that far. I think we're probably going to go sideways soon, and I was not willing to buy the 1 low or 1 point lower, so I was trying to buy closer to 2 points lower. What happens if 2 closes on its low? That creates a strong bear bar on the 10-minute chart. Here's the 10-minute chart. But the bears have the problem of a very big reversal up and unlikely to go very far down, maybe to the bottom of the channel, spike pullback channel. Are we still always in long? I think so, but I also think that we're going to test the 68 low. I thought we were going to test yesterday's high first, but we might test the 68 low first. What about the bulls who bought the 1 low? They'll probably make money. What about the bears who are selling the 2 close? I would not do that. We're right at the 60-minute moving average. I think we're still always in long, and we know there are limit order bulls buying below 1. Suppose we get consecutive big bear bars. Well, that would make us always in short, which means we'll probably get at least a small second leg down. But I need a lot more to believe that this is going to be a big bear trend day. I think it's probably going to be a trading range day, because that's what usually follows a big reversal day like yesterday. Probably a trading range day. Sometimes, if you have a big doji day like we did yesterday, the market will go above yesterday's high, the doji high, but you're usually not far. And if it goes below the low, usually not far below. So if we get below yesterday's low, we'll probably reverse up. If we go above yesterday's high, we'll probably reverse down. So today, probably is going to be a trading range day with bulls looking to buy sell-offs, bears looking to sell rallies, and will probably mostly overlap yesterday's range. And maybe a 50% chance today will be an inside day and not get above yesterday's high and not get below yesterday's low. If it's going to be a trading range day, which it probably will be, it'll have at least one leg down and one leg up. While it looks like the initial leg will be down, it's too early to tell. This could be an opening reversal up from the 60-minute moving average and the 68 low. The first leg up could be a weak bull channel looking like this, and it could last a couple of hours. Legs in trading range days typically last 2 to 3 hours. Initially, in the first hour, the market is deciding on the direction of the first leg. So is this the first leg of the day? It needs more bars for me to conclude that. Right now, I think the market's probably going to have a trading range open. We had a spike pullback channel, and that usually evolves into a trading range. And we had a reversal day, and that usually evolves into a trading range. We still have room to the 68 low. Would I sell here? We have consecutive bear bars. No. The first bear bar, bar 2, has a prominent tail, and the second bear bar is only a doji. And there is support around the 68 low, the bottom of the channel. Now, what about the limit order bulls who bought the one low and or 1 or 2 points lower? Because it's a trading range day, the market is usually forgiving of limit order traders. So I think we will get back above the one low at some point. I am currently flat. I initially tried to buy below 1, 7 ticks below 1, did not get filled. It bounced, and I did not want to buy if it was coming back down a second time. I was looking for a bounce, and we got the bounce, and that was the trade. And so if it comes down again, I'm not looking for the trade to happen a second time. We are always in short at this point, but I still think we're going to get a trading range open. Probably buyers 68 low, probably buyers the 2 low and the 3 low. What happens if 4 also closes on its low? Well, we may get down to yesterday's low, but I think more likely we're going to stabilize here. I said on the open, we have a spike pullback channel. The market usually tries to test down to the bottom of the channel, which it's doing right now, and then it usually bounces. Bears take profits, bulls start to become more confident, more aggressive. Where are the consecutive big bear bars closing on their lows? Okay, we do not have them, and that also lowers the probability that this is the start of a big bear trend day. I think this is a probe down. We have a little gap down and a bull bar, a bear bar, and then a doji bar, a bear bar. Again, tails on the bottom. That is not typical of a strong trend. I talked about that yesterday. Big bar, a bear body, but big tail, and then follow through a bull bar, and then big tail, bull bar, right? That's usually a bear leg in what will become a trading range, and this has the same look. So if I had to buy or sell here, I would be buying and scaling in lower. Are we always in short? Yes, and all that means is I think the first reversal up probably will not get far, and we'll probably test back down. We may go a little bit lower. Can you sell on a stop below yesterday's low? No. In fact, I'm not selling here at all. I'm not buying yet either, but I'm not selling. I said that today would probably try to be an inside day. Sometimes instead of an inside day, it goes a little bit below yesterday's low or a little bit above yesterday's high. usually after a big doji day like yesterday, you're not going to end up with a strong breakout below the low or a strong breakout above the high. So big down, big up, big confusion. The bears saw this rally as a pullback from this sell-off. The bulls see this sell-off as a pullback from this rally. Globex chart, 15-minute chart, still above that low. These highs failed to get above prior highs, so that's probably in part why we're selling off. The bulls got a reversal, but they could not break above prior highs. Now, what about the bulls who bought the one low? Do I still think they'll make money? Well, I'm not so sure now. The further down we go, the harder it is for the bulls to get back up there. Is it sell to close? Yes, it's sell to close. But the bars are not big enough for me to do that. So right now I'm stuck looking to sell a rally or waiting for a micro double bottom to possibly buy. Let's say we get a bull inside bar on 6. I might buy below it, betting against much more down. It's still sell to close, right? But whenever you're selling the close and you're near support and the sell-off is not all that strong, you can only do it if you can make quick decisions, because the odds go up that we will get a disappointment bar pretty soon. And then you have to decide what to do. For example, yesterday 59, sell the close, but disappointment bar 60, and you have to decide, try to get out break even, and it looks like a lot of the bears did. You can see on the daily chart, we're testing yesterday's low, and remember we reversed up from this price, and there were a lot of buyers there, so there probably will be buyers in this general area again today. Is it a parabolic wedge? Well, not a great looking one, maybe on a smaller time frame. It could be a spike pullback and second push pullback, third push on a smaller time frame chart. Now what about buying above 6 for a low today? Weak follow through, we have a small gap, a bull bar, a bear bar, a doji bar, a bear bar tail, a bear bar, and so far it looks like a bull bar. And you have theoretically limit order bulls who bought the one low, and some of those bulls will use a wide stop like below yesterday's low, and then look for a bull bar, maybe bar 6, and buy more above that bull bar, either to ride it all the way back up to the one low, getting out break even on the one low and with a profit down here, or they're so disappointed by the sell-off, they'll try to get out break even on the entire trade. So let's say this is one tick above the bar. That would be the average entry price. And some of the bulls who buy the one low and buy more above a bull bar will be so disappointed by the size of the sell-off, they'll be happy to get out at their average price. So they'll lose a little here, they'll make the same amount here, and they'll avoid a loss by getting out here. And therefore, there's a magnet at this midpoint. So what do? Do you buy above 6? Well, it's sell to close. So if 6 has a decent bull body, the bears get out. Right? I would get out above a decent bull body. Let's say it has only a 1 tick bull body. Do the bears get out? I would still get out. And if it has a 2 or 3 tick tail on top, will the bulls buy? A lot of them will wait. If it closes on its high tick, I think the limit order bulls will buy. And I think either we'll go up or we'll go down a little bit more and then go up. I sometimes cheat when I think the market's going to bounce. I bought the close of this 1 minute bar and I've already scalped out. Sometimes if I think the market's going to bounce and I'm looking to buy, I'll put up a 3 minute chart, sometimes even a 1 minute chart. On the open, I'm more likely to use a 1 minute chart, and then as soon as I see a bull bar, I'll buy the close and put a stop below here and add on a little bit lower. So I would get out of shorts above 6, even though we might go down a little bit lower. This is a disappointment bar for the sell to close bears. And for the bulls, it's not a great buy. Let me make this more exact. You have scale in bulls who bought the one low, so they bought here, and then they're looking to buy one tick above a decent bull bar, which we have. So one tick above is right here. Their average entry price is right here, and the market usually rallies at least one tick above that average price, and that allows them to get out break even on the trade. Right now, I still think we're going to get back to the one low. Do you remember during the sell-off yesterday, I said that I thought we would get back to the prior day's low? And at the time, it probably didn't look like it, but I thought it was likely. And right now, I think the limit order bulls will be able to avoid a loss, because today's probably going to be a trading range day. And if you do something reasonable, buying the one low was reasonable. And if you're able to use a wide stop, trade small, and scale in, you usually are able to avoid a loss. Like 90% of the time, you can avoid a loss. Six-bar bear microchannel, probably sellers above. Probably the bulls will need at least a micro double bottom, but I would still get out of shorts above 6. Because even if there are sellers above, and even if we go lower, we're probably not going to go much lower. Now, what do the sell to close bears 5 do? They're obviously upset, right? And a lot of them, some will patiently scale in, selling either 1 or 2 points above the 5 close, and then hope to get out at the 5 close. Others will get out above 6, which I think is the best choice. And for the bears, they can say, we got a 6-bar bear microchannel in the open. There are sellers above 6. That is right. There probably are sellers above 6. But whenever you get a strong reversal bar like that, in this kind of a context, I said on the open, today would probably test yesterday's high and yesterday's low and fail to get much beyond either. The context for a reversal in this general area is good. So I would not sell the 6 high. On the open, I said a trading range today was likely after yesterday's reversal. And the trading range will probably be pretty much overlapping yesterday's range. And therefore, we are low. And in a trading range, I want to buy low, not sell low. And I certainly don't want to sell low at the high of a strong bull reversal bar. Consecutive good bull bars. Still probably a minor reversal, which means probably we'll end up testing back down to the 5 close, even if we go up several more bars. But it's bad for the bears. Who is going to sell using a stop below 7? All right. Individual traders, a discretionary trader is not going to do that because there probably are buyers below 7 and buyers below 6. If you're a sell the closed bear 5, what are you thinking? Are you thinking, oh, I'm going to add to my shorts? Or are you thinking, we're fairly low, it's probably going to become a trading range. I was selling closes until we got a disappointment bar 6, and then my thought was I would get out, break even on my final sell. And I think that's what the sell the closed bears 5 are thinking. They were hoping we would get 1 or 2 more sell the closed bars so they can keep making money. And their plan was, as soon as they got a disappointment bar, to stop selling closes and expect a trading range. The limit order bears 6 high needed it to drop 5 ticks, which it just did. So you have bears buying here, and then you have the sell the closed bears bar 5. Are they going to hold on to their shorts, or are they going to say, no, that's more of a reversal than I was hoping to see. I'm simply going to get out, break even, or maybe with a 1 tick loss. So you have the sell the closed bears also buying back shorts here. Sometimes in a situation like this, where it's clearly disappointing for the sell the closed bears, they don't get out. For whatever reason, they continue to hold, and you get another leg down. But as I said, even if we go down more, I think the odds are against it from going down very far. The follow-through has been terrible. We have a gap down and then a bull bar. We have a bear bar, then a doji. A bear bar with a tail, consecutive bear bars, but then consecutive bull bars. Limit order bulls bought the 7 low, and they need a little bit more bounce to get out. Bulls trying for a micro double bottom. If it goes above 8 or above 7, that is a micro double bottom, but it's forcing bulls to buy fairly high up. Limit order bulls 7 low need 1 more tick. Okay, they just got it, right? And the bears who sold 5, you can look at the 8 low. They placed limit orders to buy back with a 1 tick loss. A lot of them placed the limit order to get out 1 tick above the 5 close. So the bears are getting less confident. The bulls are getting more confident. It's still probably a minor reversal. So even if we rally for 10 bars, an hour or so, we'll still probably test back down here. The bears are still on their low 1 short below 7. If they did not get out above 6, they'll get out above a bull bar, either 9 or 7. You get a sense that this is getting confusing, and that is telling you that we're probably in a trading range. Whenever you have clarity, a sell to close trend, and then you start looking at it and you start seeing both bull and bear setups, things are confusing, and that usually means that we're forming a trading range. Bears will start to sell and scale in above things and scale in higher, and bulls will look to buy below. The bulls bought the 7 low, the bears sold the 6 high, both made money. A lot of times, if you get a strong sell-off, you'll get a reversal up for the rest of the day in a channel. I'm trying to find a good example of what I'm talking about. Well, this is a little bit. So strong sell-off and you reverse up in a channel. It's a bear flag, but it can become endless and become a bull trend. I gotta move a slide over here. This is the kind of thing I'm talking about. Strong sell-off and reversal not all that strong, but it just channeled up, channeled up, channeled up. Here we ended up getting a bull breakout. But this is what sometimes happens where you get a strong sell-off, testing yesterday's low. Here, a little bit below yesterday's low. So far today, a little bit above yesterday's low. And it reverses, probably a minor reversal. Here, the test back down to the low close was very brief and never clearly strongly bullish, yet that initial sell-off, as strong as it was, became the low of the day. Bears a low too short, but again, bull body bar 9. And remember I said a lot of bulls would like a second entry buy above another bull bar. Bar 9 is that second entry buy signal bar, but so far the bears have been able to prevent the bulls from triggering that buy. It's a swing buy above 9. I don't know that the probability is high enough for a scalp. Because it's a low 2, even though it's a bull bar, I typically do not buy that 9 low. A low 2 in a bear trend, even if it has a bull body, I usually do not buy it because there's just too much risk of another leg down, even with a bad looking sell signal bar. Bulls trying to prevent the bears from triggering the low 2, and the bulls trying to trigger the reversal up. I think bears will get out above 9 or above 7 if they did not already get out. Remember, if you're trading always in and you get out above 6, theoretically you're going to sell again below a pretty decent bear bar. 8 is probably not decent enough. So I think just going below 8 would not be enough to make the bears sell. But if 10 closes on or near its low, I think a lot of the always in bears will sell on a stop below 10, looking for another leg down, maybe down to around yesterday's low. You know, the bulls are buying here, but the aggressive buying yesterday was here, a little bit lower. So we may come down to this area. The market reversed up 5 times, down, up, down, up, down, up, down, up, down, up. So we may have to come down and test this area. Breakout mode. It's a second entry buy above 9 for the swing bulls. And for the bears, always in bears sell again below 10, but I think the odds are against the market going much lower. Will the always in bears scalp? Theoretically they're swing traders, so they're not going to scalp. They're going to take a chance that we break below yesterday's low. As I said, even if we do get below yesterday's low, we'll probably not get far below it. Bulls want a wedge bottom. Can you buy the 6 low? Well, they made money buying the 7 low, so bulls will buy the 6 low and scale and lower, relying on all the buying that took place yesterday in this general price area. But 10, 11, strong enough. I think we're going at least a little bit lower. Bears scalping, looks like. The bears are sold below 10. Looks like a lot of them bought back their shorts at one point or at the 6 low. For the bulls, a double bottom, 6 and 11. But the 2 bear bars, 10, 11, are big enough, I think, to make a lot of the bulls hesitate to buy above 12. Bar 12 is the end of the first hour, and the bulls are trying to put a tail on the bottom of that 60-minute bar to make it look less bearish. I know it does not look like a wedge, but it is a wedge, and I believe that's how a lot of the computers read it. A high or low, 3 pushes down. No, I'm not buying above 11, a bear bar, and I probably will not buy above 12 either, even though I think we're trying to put in an early low of the day. That's the end of the first hour, and like the past 4 bars, fairly prominent tail, so sideways type market. I think the bears again get out either above 12 or above 7. We have a double bottom, and that's the neckline. Not likely to sell off much more from here. We're getting bad follow through all the way down for the bears, and that usually happens if the bear leg is going down to test support and not going down relentlessly all day. So I still think we're going to bounce, possibly become a reversal day. Remember, I don't know if you've been paying attention to the news. There's all this hype about the Apple iPhone 10 coming out here, and so many people on television were saying it's a buy, it's a buy, it's a buy, and I'm saying, to me it looks like it's at the top of a channel, and micro double top. Why would anyone buy up there? Also, we broke strongly above this high, just like we've broken strongly above this high, but look what followed. Right, so we're probably coming down to test below this high. It's a pretty tight channel. We might have to go sideways first, but all those people on TV who are saying, oh, it's going to be such a great product and Apple is going to go so much higher. To me, I'm looking at, I drew these lines in, months ago. Here's the monthly chart. When the market was somewhere down here, I drew these lines in. And now we're finally there. There are a whole bunch of other companies that make product for Apple. So if Apple goes down, they have to buy less components or fewer components, and those companies go down as well. Possible low of the day, wedge bull flag after yesterday's strong rally. So okay, swing buy, but not yet always in long. The bulls need 2 or 3 more decent bull bars for traders to believe this is the low. Can you sell the 12 high? There's no way I'm going to do that. We have 2 reversals up, both with good looking bull bars. I'm not selling at the high of those bull bars. So I think bears get out. Swing bulls can buy. Other bulls will wait. When we got this close to these lows, I thought we may get a little bit lower, but we might not. This might be a wedge bull flag and the low of the day. If 13 becomes 2 or 3 ticks taller and closes on its high, then we're probably always in long. If it does not become 2 or 3 ticks taller, then we might go sideways more for several bars. Well, the bears double top 7, but we're getting a lot of bull bars closing on their highs in a support zone, a price level yesterday where they bought aggressively many times. Probably always in long. 5 decent bull bars, and here we have a pair of consecutive bull bars. However, the bars are not all that big, and therefore it reduces the chances of a big bull trend day. If the bulls get 1 more bar, I'm not sure that they will. The bears had disappointment on their follow-through bars all the way down, so I think the bulls will get disappointment on either 14 or 15. The bears still have a double top 7, but even if 14 is a strong bear bar closing on its low, I think a lot of bears will not take the short. When you get double top bear flags like this, they never look good, but they still have a 40% chance of breaking below the neckline and falling for a measured move down. Important bar. Going 1 tick above 7 is good for the bulls. Going 2 ticks above 7 is better for the bulls. It reduces the chances that a double top bear flag will be successful. If right now, if we go below 14, this is a double top bear flag and a bear trend, 40% chance we break below 11 and fall for a measured move down. That means 60% chance we don't. So the 60% chance there are buyers somewhere below 14 and around the 11 low. It may dip a little bit below 11 and form an expanding triangle, 1, 2, 3, but only 40% chance that we're going to continue down for a swing. So 40% chance of that measured move down. I think we are always in long, but the next few bars are important. If 14 had a slightly bigger tail, bulls would be more willing to buy the 14 low. But, I've been saying since the open, trading range day. And trading range day means that probabilities are never going to be as good as traders want. The market is going to be doing things that make you think something's going to follow, but nothing looks quite as good as you would like it to look. Follow through is bad. Signals are bad. And when you have good signals, the probability that they work is closer to 50-50 instead of 60%. And that's just the nature of trading range days. everything is less certain. The one thing traders are certain of is the market's probably not going to go all that far. So it's probably not going to go far up, so they start to sell when it goes up. It's probably not going to go far down, and they start to buy when it goes down. Still always in long, but not all that bullish. The bulls are hoping for the channel up, and the bears are hoping for the double top bear flag and endless pullback, and then break below the neckline. Double top bear flag. The bears started to get the sell off, trying to get below the neckline, but it stalled. We'll get a higher low, and then once you get that, a gap, a big bull bar closing far above all these bars, you're probably going to get a swing up. So this is what the bulls need. They need a give up bar. Bulls trying to get their breakout. We have a lot of bull bars closing on their highs here. We have 5 bull bars closing on their highs in a buy zone. Remember those limit order bulls, one low? We're still probably going to get above that one low. You know, if they bought more above 6, this is their average entry price, and right now they can get out without a loss. So they buy the one low, they buy more above the bull bar, use a wide stop, and right now we got one tick above this price, and that means the bulls could get out without a loss had they bought the one low. Remember, I said today would probably try to be an inside day. In other words, it would try to test yesterday's high and low. I thought we were going to test yesterday's high early on because we opened near the high, but instead we tested yesterday's low first. The stronger this bar is, the more likely we'll get a measured move up. But we had bad follow through on the way down, and so far not particularly good follow through on the way up. The bears are hoping that this is a 50% pullback from the initial sell off and a wedge. We have a double top and a breakout, and therefore the bears want a reversal, and they'll think of it as a wedge. Important bar for the bulls, right? Are we at the start of a bull swing, or is this a bull leg in a trading range, and is the top of the range around where we are? 50% pullback and at the 60-minute moving average. Who's going to sell below 17? I think it's not a good sell. Disappointing breakout, and that's consistent with what we knew from the start of the day, that it would probably be a trading range day. After the first hour or so, there's 70% chance we've seen either the high or low of the day. And now we're on bar 18, and by the close of bar 18, 90% chance we've seen either the high or low of the day. Bears made money selling the 7 high. It fell 5 ticks. Scale and bears sold the 14 high, sold more 1 point higher. It looks like they'll probably make money. And if it's easy for bears to make money in a bull trend, the bull trend usually is a bull leg and what will become a trading range. The bulls, therefore, are going to try to keep the bears from making money. The bears need it to fall one tick below the 14 high. Right now, I think a trading range is likely. We're at resistance, 60-minute moving average, 50% pullback, and we have a big tail on the top of 17. Therefore, I think we're going to fall below the 14 high, and the limit order bears who sold either the 14 high with 1 point higher or simply 1 point higher should make money. Where will the bulls buy again? Well, the bottom of the most recent buy climax, this minor higher low, probably buyers around there and probably buyers down here. Always in long, but not strongly bullish. So far, the bulls are keeping the gap open, but I still think it's going to close because I think this is probably a bull leg in a trading range. I also still think we'll get back to the one low. I think it's a trading range day, probably an inside day, and we have an early test of yesterday's low, and therefore we're probably in a 2 to 3 hour channel up to test yesterday's high. 18, a high one buy, but bear bar, tail, 60-minute moving average, 50% pullback. I don't know that it's a good stop entry buy, even though we have a breakout test, 18 low testing, 14 high. So the bulls are hoping for the measured move up. Not a strong buy, 50-50 chance sellers above and that we pull back more. I often sell that 18 high, but because of the gap with the 14 high, I did not take this sell, even though I think it's probably more likely than not that there'll be sellers above, but probably is not necessarily high enough probability to take the short. Where would my stop be if I take that sell? I'd probably have to put a stop, somewhere up here. And I don't want to risk that much to make 1 point, especially because if we start to go up, then this then becomes increasingly likely a measuring gap. And we'll probably get up to the target. High of the day, the measured move up. If 18 dipped 2 ticks below the 14 high, then I would be more willing to sell the 18 high, the 17 high. Bears failed breakout above a double top, wedge top, so 1, 2, 3, a micro double top, but a fairly tight bull channel, not a great looking stop entry sell. However, if it does dip below that 14 high, we'll probably try to get lower down to the 16 low. The bulls are trying to keep the gap open for a measured move up. Bulls trying to keep the gap open, but trading range day likely, so you have to assume the market will fall below support, the 14 high. If the bulls are able to keep it open, this then becomes a small high 2 bull flag and a reasonable buy for a swing up here. Forcing bulls to buy really high. Limit order bears 18 high did not make money. If the bears get a second entry short 21 with a decent bear bar, that probably would be an okay scalp. As far as swing goes, I think we're always in long. And when you have a trading range day, the legs usually last 2 to 3 hours. And therefore, I think we'll be sideways to up for at least another hour. So even if we pull back, we'll probably get a higher low and either continue sideways or up. This breakout test is important, right? We tested it twice, the 14 high, and reversed up, trapping the limit order bears who sold the 14 high. Let's say we get a reversal 21. I would get out of longs. It's a little bit of a wedge. First push, second push, third push. We might get a couple legs sideways to down. So I would get out of longs, and if it's a decent bear bar, it's probably an okay short. It has a one tick bear body. What about shorting it? I probably would not. Even if it has a 2 or 3 tick bear body, we're still always in long, and the best the bears probably will get will be a test down to this area, 2500, the 16 low. Remember I said the one low was a target, and we got right to it. I still think we'll get one tick above. I think it was reasonable to buy the one low, and therefore limit order bulls who scaled in above 6 and or 12 probably will be able to get out break even on their first entry at the one low. So I think we'll probably get at least one tick higher here. Now wedge, and we got the target, plus we're at the resistance of the 60-minute moving average, but a very tight bull channel, and the odds are we're going to go at least one tick above the one low, and that lowers the probability of the bears selling below 21. Also, the channel is very tight, and if you get a reversal down in a tight bull channel, it's usually minor. So probably if we fall below 22, we'll go sideways and then try to get above that one low. Also, the day is probably going to be a trading range day. You can see on the daily chart, so far it's a trading range day, it's a doji day, and we still have a lot of room up to yesterday's high. I don't know that we'll get there, but yesterday's high is a magnet. Buyers or sellers above 22. Well, we have a wedge, so probably sellers not far above. And then we have the one low where I think a lot of scale in bulls will look to take profits. So I think probably sellers above 21, sellers above 22. We're getting near the end of the second hour, and the bulls have a double bottom and a decent buy signal bar. At least it looks like it'll be a decent buy signal bar, but it's also a 30 bar tight range with many big reversals. So even though it's a good looking buy signal bar, the context is not very good. Probably sellers were in the sell zone around the one low. I think we're going to get above the one low. It's possible that we pull back to the 20 by climax low and moving average first, but I think we'll get there. Bears did not make money selling above 14, and so far have not made, and they did not make money selling above 18, and so far they have not made money selling above 17. So small pullback, bull trend, still probably a bull leg and what will end up as a trading range day. However, it's difficult for the bears to make money, and when that's the case, it's usually better to be buying, looking to buy. for buying, I would rather buy a pullback at this point. Bad follow through, small bars, tail, doji bar at resistance. Do I think the limit order bears will make money? Yep, just like I thought the limit order bulls below 1 would make money. If we start to race upward, obviously, the character of the day will have changed from a trading range day into a bull trend day. But right now, it's still probably a trading range day. We're getting near the end of the second hour, and you can see the bulls getting a pretty good looking bull bar. Objective met. We went above the 1 low, so you should get some profit taking here. 60-minute bar closing in about 5 minutes, and the bulls trying to get the bar to close on its high. And the bears are trying to put a tail on it, just like down here, bar 12. That rally put a big tail on the bottom of the 60-minute bar. And if the bears can get a sell-off over the next bar or two, they'll put a big tail on the top of the current hour. Because the channel is tight, whatever reversal the bears get will probably be minor, which means probably a bear leg in a trading range. And therefore, bulls are willing to buy at any price because they're confident if it reverses down, it'll bounce, and therefore they can buy more lower. It'll come back to their first price. They can get out break even on their first entry and then with a profit on their second. On the other hand, if it continues in a small pullback bull trend, they simply make money on their first entry. Bar 24. Any multiple of 12, the final bar of the hour on the 5-minute chart, often is a reversal, and it tends to put a tail on the bar, just like the last bar of the first hour reversed up, and now this is the last bar of the second hour is reversing down, making the 60-minute bar less bullish. Still 3 minutes left. Bulls trying to close the 60-minute bar on its high, making it a better high 2 buy signal bar, high 1, high 2, but it's still in the middle of a 20 bar tight range, and that limits the likelihood that we'll break strongly to the upside. Also, on the daily chart, because yesterday's a big doji bar, that limits the likelihood that we're going to break strongly above yesterday's high. I don't even know that we'll get above yesterday's high, but if we do, there probably will be sellers above. Five-minute sell from a wedge and 60-minute buy from a high 2 buy. A small pullback bear trend, selling with stops, usually a losing strategy. Selling with for any reason, usually a losing strategy. But, the rally looks like a bull leg in a trading range day. Every small pullback bull trend looks like a bull leg in a trading range. But this actually is a bull leg in a trading range. And therefore, it's, I think, more likely to not continue all day, more likely to start to pull back and go sideways soon. Decent enough buy signal, 60-minute chart, so that we probably have to get above last hour's high, which is the 24 high, even if we pull back down to 20 first. This is a type of consecutive top situation. We had a double top bear flag, and we broke to the upside. And now we have a wedge top. That makes it slightly higher probability that we'll pull back. The bulls are trying to get above that 60-minute inside bar to trigger the buy signal. But I think more likely we're not going to go very far up before we start to pull back. at the moment, I think we will fall back below the 14 high, but I just don't know if we'll go higher first. A lot of bears do not want to take the stop entry short because limit order bears fail to make money above 14, and so far they've failed to make money above 17. However, I do think we'll go down either here or after one more push up. I think this is not going to trend up all day. I think coming into the day, I thought trading range day. I still think trading range day. I would not buy the 24 low. If it was a small pullback bull trend and I thought it was going to last all day, I would buy the 24 low. But I think this is consecutive tops. We tried to top, we got a breakout, and now we're trying to top again. So it increases the chances that this is going to become a trading range over the next 5 or 10 bars. Probably sideways for the next 5 or 10 bars. Bulls, I don't think they buy the 25 low, but they probably will buy 1 point lower, 2 points lower. And for the bears, it's probably better a limit order sell. I'm not sure that it's going to fall far enough below 25 for the stop order bears to make money. You know, it's a small pullback bull trend. That means the pullbacks are small, and stop order bears need it to fall 6 ticks below the 25 low, and that would be 11 ticks below the high, and that's not small, that's big, and the market's not doing that. This is a small pullback bull trend. Probably going to go sideways here, so probably sellers above 26, sellers above 24, and buyers below things, you know, probably a point below 24, maybe around the 20 high and the 20 low and the 14 high. So this is a reasonable buy zone. For the bulls, a failed wedge, but it's still a wedge. I still think a couple legs sideways to down. Limit order bears did make money selling above 17, above 21, 22. Will they sell above 26? Well, we know they'll sell above 24, and if they might sell above 26 as well, looking for a test down below the 14 high. I would not buy. I would wait for a second leg sideways to down. For the bulls, they have a high 2 buy at the moving average, a small pullback bull trend, although this pullback is a little bit bigger. It's only 1 bar down. You know, it's lasted a few bars, but it's only 1 bar down. We're always in long. However, I think that more likely we're going to be more sideways here than up. So not a great looking buy. The stop entry bears who sold below 25, a lot of them will hold short on the first resumption up above 26, but most bears selling with stops in a bull trend will get out the second time the bull trend tries to resume, like above 29, especially if 29 closes on its high. So, and that's one of the reasons why high 2 bull flags have a high probability of success. You got the stop entry bears giving up. They'll allow the bull trend to resume once, but they will not allow it to resume a second time, especially if 29 is a bull body and the bull flag is just above the moving average like this. So chances are, if 29 has a bull body, the bears will get out. Limit order bears who sold the 26 high had their limit order, profit-taking limit order hit repeatedly, but they have not been filled, and those bears will buy back their shorts, especially if 31 is a bull bar. 60-minute bar, we still have that bull inside bar, the reversal, and even though it has a tail on top, it's still good enough so that we might have to get above its high. The bears, we're still always in long on the 5-minute chart. Will the bears get out above 30? It's still, I don't know. I would. If I were short, I would get out. And the bulls, they would like to get a bull inside bar 31 for the buy. Do I still think we'll get below the 14 high? I think at some point today we will, but we still might get above the high of the day first. Still always in long, still likely to go higher. Also, when you have a trading range day, which today is, at least so far it is, after the initial leg here, the initial leg is off in an hour, and after that initial leg, the market starts to get swings 2 to 3 hours long, and this swing has only been an hour and a half, so probably more sideways to up. Even though not a good buy signal bar, I would get out of shorts. For the bulls, buying here a little bit tricky because we still may go lower. Math is, I think, difficult. If you buy here and put a stop here, you're risking 5 ticks to make, let's say, 4 ticks if you're a scalper, and I'm not sure that it's worth it. It'd be better to use a wider stop here or here and look to add on lower. The always-in bulls who get out below 24 usually buy again above a bull bar, and 30 is not a bull bar. 31 is, and therefore probably the always-in bulls will buy above 31. Will the bears sell here, betting on a continued tight trading range? I would not. And for the bulls, it's more likely to go sideways, but we're always in long, and we may go, it's possible that we go up. I still think the odds are we're going to go sideways more. Stop order bulls 30 need one more tick. The bears want the double top. Always in long. We still have that measured move target above, and we still have the magnet of the high of the day and yesterday's high above. So probably we'll go at least a little bit higher. Also, we have to probably get above that 60-minute high, which is the bar 24 high. That's a buy signal, a high 2 buy 60-minute chart. Probably sellers above 24 scaling in higher, probably sellers above the high of the day, and sellers above yesterday's high. Even though a small pullback bull trend, it's still more likely a bull leg and what will end up as a trading range. Yesterday was the doji day, closing near its open. The day before closed near its open, and right now, today, we're near the open, and the open of the day might end up as the most important price of the day, so we may end up closing around the open. Can you buy here or on a breakout above 24? Arguing it's a buy signal on the 60-minute chart. I would not. On the 5-minute chart, limit order bears made money selling above 17. They probably will make money selling above 24. The bears would like to create a double top with 24, break below the neckline, and then fall for a measured move down. But not many traders will sell below 33. And even if 34 is a bear bar. I think a lot of bears will not sell below. Stop order bears did not make money since bar 10, and 33 is a good enough bull bar, especially after 31, to make it likely it's a breakout of a bull flag. So this bear channel is a bull flag, and we broke out. More likely buyers below 33 or 34, and a little bit more up. Less likely a successful double top, break below the neckline, measured move down. Bears have their double top. The stop order bulls above 30 have a 5-tick trap. As for selling with a stop below 30, betting on the double top, you're selling at the bottom of a very tight range, and the downside is probably not all that much. You can argue that it's a 50% pullback from this sell-off and a stall at the 60-minute moving average, but it's more of a limit order market. If we do get a big breakout on 39 and 40, traders will start to sell closes, but more likely it's not going to be all that clear. Limit order bulls might buy the 31 low. I would wait a little before taking the buy. The bulls have had a lot of time to go up. They have a high 2, always in long, and we're getting a surprise bar, 39. Whenever the market does something that is surprising, it usually has at least a small second leg down, and because of that, I think the bulls should wait at least another bar or 2 before looking to buy. If 39 closes around its middle, and then if 40 has a bull bar, then this sell-off becomes a high 2 bull flag, 2 legs down, 1 pullback 2. We had an example of that. Well, here's one example, 1 pullback 2, and then we had another example. There's a small example, 1 pullback 2, and then here, 1 pullback 2. The bears tried to get a double top, break below the neckline, and a tail, and then bad follow through. It became a large high 2 buy, so bull trend, 2 legs down, and resumption of the bull trend. this happens all the time, right? A big bear bar probably will get at least a small second leg down. However, close at the 31 low. The bar is not all that big. We've had many bigger bars today, and it has a big tail, and therefore it's less certain to lead to lower prices. It's also a test again of the 14 high. I left this red line in here. Therefore, if 40 is a bull inside bar, for example, a lot of traders will buy, looking at it as another test of the 14 breakout point and a high 2 buy, leg 1 pulled back leg 2. And for the bears who sold, let's say you sold the breakout below the neckline, the 30 low, what are you thinking now? You're thinking, uh-oh, this is not doing what I want it to do. High 2 buy. Will we get a second leg down? We might. I'm not confident that we will. But, the picture is confusing, right? Whenever you have a lot of trading range behavior, nothing is 60%. Everything is close to 50-50. While normally you'd look at this and say, always in long, high 2 buy, it should be 60% chance that we go higher. That's not the case. The bears will argue, well, normally you get a big bear breakout, 60% chance you get a second leg down. Not the case. I think it's better than 50-50 that we go up, but it's really more of a limit order market. And I did not buy the 30 low, so right now I'm on the sideline. Still confusing, in the middle of a 20 bar tight range, still always in long, but stop order traders have been struggling to make money. The bears made money below 38, but the bulls did not make money with their high 2 buy above 30. All three moving averages are flat and within one tick of one another, which is very unusual. Anyone going to sell this on double top, lower high, top of a tight trading range, low 2 with 43? I don't think a lot of traders will sell. We are still always in long, and we have 7 bars without a bear body. We've already had a small second leg up. The first leg up ended when 44 fell below 43. 2 point tall, tight trading range. I think best choice is flat. Since we're always in long, second best choice is long. And then another choice is sell a breakout above the top of the range, test of the high of the day. Bears trying to get their breakout. You got a double top neckline, measured move down. It's going to be hard to go very far. We're in the middle of a trading range. All three moving averages are very close to one another. And on the daily chart, past 3 days have been dojis, so today probably will not get very far from the open of the day. We have a rally in a tight range. In general, 50% chance you get trend resumption up, 50% chance you get trend reversal down. I think it's slightly higher that we get trend resumption up because yesterday was a big doji day, outside day, and we reversed up from yesterday's low. Typically, most of the time, you then try to test the opposite extreme. So I think it's slightly more likely that we'll get a bull breakout of the tight range. Also, whenever you have a rally and then a trading range, it's always going to be slightly more likely that you'll get trend resumption up. The opposite is true if you have a sell-off and then a range. The probability is slightly higher that you'll get trend resumption down. Trend resumption is always at least slightly more likely than trend reversal. Obviously, if you go sideways for 1,000 bars or 100 bars, there's some magic number of bars when the probability becomes 50-50. But this is probably not quite enough bars. It's close to 50-50, but I still think more likely up. It's interesting that the bulls have not had a profitable stop entry buy since bar 20, and the bears have had profitable sells below 38, 48, and 56. Makes me wonder if we'll get a bear breakout and a test back down to the low of the day. Robert Shiller is a Nobel Prize winning economist from Yale, and I respect him. I think he's a pretty smart, conservative guy. Doesn't say outrageous things. I have to say part of my bias in favor of him is that one of my daughters graduated from Yale. Anyway, he wrote today in Market Watch that he thinks that there are fundamental things going on with the economy right now that are consistent with the last 13 20-point corrections. And he makes the obvious point, the one that I've been making for many months, that even if a correction, a 5, 10, 20% correction is likely, timing it is very difficult, and the rally can continue a lot longer before you get the correction. And that's always the case with corrections. Whenever you're predicting corrections, obviously, ultimately, at some point, you're going to be right. But the question is timing, and can you make money shorting while waiting for the 20% correction to take place? He's not advocating shorting, but he is advocating being aware of the problem and protecting any longs that you have. Timing is always an issue. Warren Buffett made the point recently that the Dow is going to 1 million. And, the Dow currently is 20,000. So is that an outrageous comment? Not at all. I have no doubt that the Dow is going to go to 1 million, which is 50 times higher than it is right now. And the stock market right now is at 2,000, but I think it's going to go to 100,000. Absolutely. I have no doubt that it's going to go to 100,000. But what is in doubt is the timing, and I probably will not be trading when the S&P does hit 100,000 and when the Dow hits 1 million. However, the market has been going up forever. As the world population increases, you have more workers and you have more goods and services being created. So the world's GNP or GDP goes up, and the stock market is a measure of earnings. And if the world's wealth goes up, the stock market goes up. And it's been that way forever. Until the world's population stabilizes, the odds of the market going down for any protracted period of time are virtually, non-existent. As long as we keep making more people and these people are all working and producing stuff, the world's economy is going to increase and the stock market is going to go up. In addition, you have technological advances, so productivity increases. It takes fewer people for a company to make the same money that it was making previously. Productivity is going to increase forever. What we don't know is when the world population will stop growing. At some point, it will stop growing, and in fact, it probably will decrease. However, if the decrease is not enough to offset the productivity gains, the overall stock market will continue to go up forever. I think what will happen is the rate of increase will become much less once the world's population stops growing. And at some point, the world's population will stop growing. As countries become richer, their population increases go down. And a lot of countries right now are at zero population growth. And, the poorer countries, you can pick Africa, Asia, South America, Europe. At some point, they will have enough middle-class people, enough well-off people, so that their populations will no longer grow. And I don't know what number of people that will be. Will it be 20 billion, 30 billion people? At some point, in the next century probably, the world's population will no longer increase. And that means that stock market prices only go up based upon improved technology, improved productivity. And so the part of the GDP growth due to population increase will go away. And therefore, a big driver in the stock market going up over the past 1,000 years will no longer be present, and we'll be left with simply increased productivity alone. And over time, that will get less. And what will happen is the stock market will fail to continue to go up, and it may end up just going sideways, sideways to up in a broad bull channel on the monthly or yearly chart forever. And in any case, the rally that we've been in for thousands of years probably will not last more than another century or two, and the market will then essentially be flat, forever. Slight upward bias, but basically flat forever. Okay, bulls have another test of the 14 high, and they have a bull buy signal bar, but they have not made a profit in 40 bars with a stop entry, and that makes a lot of bulls hesitant to buy above 62. And the bears have had profitable stop entry trades 4 times since bar 36, and that makes them want to continue to sell rallies. We have a lower high here, and then lower high, but we're not getting lower lows yet. I still think most likely we'll close in the middle of the day, around the open of the day. You can see right now over here, so far it's a bear doji, and I still think we'll end up with a doji body, close somewhere near the open. But it's possible that we could close near the low. That would create a bear IOI on the daily chart, and that would be a sell signal going into tomorrow. As you know, I keep talking about how every breakout comes back below the breakout point. We're going to get below this breakout point. This pullback got very close to that low. When we get this pullback, I think it'll get to this low, maybe below it. So I think we're in line for a bigger pullback, maybe 100 points, maybe more. As far as the 20% correction goes, I think there's no reasonable reason to expect that anytime soon. Also, when we finally get it, it will never look like a 20% correction is underway. A lot of the big corrections over here, they keep looking like, well, looks like a double bottom, looks like a wedge bull flag. Right? They keep trying to bottom. Okay, another wedge. Okay, breakout. Maybe we'll get a measured move down. Not much more down. Maybe this is the weekly S&P. Breakout. Open on the first bar, close the second bar. Did not quite get there, but then this became a bottom, and we totally reversed that sell-off. But anyway, the point is that if you're going to get a 20% correction, this is much more than, this is like a 60% correction. If you're going to get any big correction, as it's happening, it always looks like a bull flag. It always looks like it's going to go back up. It's going to go back up. It's going to go back up. But it keeps forming the lower highs and keeps going down. Is it sell closes? I would not. It's still a breakout below a trading range. Bears trying to get down to the low of the day. Bulls want the breakout to fail and then get a second leg up to the high of the day. Pretty good looking bar so far. Limit order bulls buying the 61 low. We tried repeatedly to get a rally from the 14 high, and now we're breaking below it. And the breakout is big enough, we fell 6 ticks below it. The breakout is big enough so that we'll probably get at least a couple small legs down, so at least a small second leg down. Also breaking back below 2,500. $39 was a breakout, and it failed, but the rally failed to get above the prior high, formed a lower high. As if 64 closes on its high. Well, bulls might buy it for a failed breakout, but I think they would want a pretty decent bull body. We had that tail on 39, and we got a rally from it. Limit order bulls definitely bought the 61 low and 1 point lower, or simply 1 point lower, and the bears are trying to get a gap and measured move down. A lot of times when I see a breakout like this with decent momentum, I'll put up a 1 minute chart and sell at the high of the prior bar. And I had a limit order to sell at the high of this bar, and I did not get filled over the next 2 minutes, and I went ahead and canceled the order. I wanted the order to get filled early in the 5 minute bar and then go down, and it's getting too late. So if it gets filled now, it's getting filled after the 5 minute bar already has a fairly big tail on the bottom. Continued confusion. Right, the bears have a breakout below a key price, but a 2-bar reversal. For the bulls, they're hoping for a wedge, 3 pushes, 52, 59, or a big high 2 legs down, 1 pullback 2, but tight bear channel, not a good stop entry buy. And then you have the bulls who bought the 61 low and 1 point lower. They needed to go up 1 more tick. What am I doing right now? I'm flat. I tried to sell during 64, but I wanted to do it early in the bar, and I did not get filled. Limit order bulls made money. I'm not sure that it's worth taking the stop entry by 65, despite the failed breakout and the wedge and the test of the 12 buy signal bar high. Remember, the open of the day is a magnet. We might get drawn to it by the end of the day. It's a magnet because of the daily chart. Past 3 days closed around the open. 15-minute higher low. Decent looking bar, 15-minute chart. Trading range, we have higher lows and lower highs, triangle. The issue is whether the probability is high enough for a scalp buy. And I'm not sure. You're buying pretty high up in a trading range. Stop order bulls finally made money for the bears double top 60, but the bears should have had a second leg down. Instead, we get a reversal up. Therefore, more likely buyers below 67 than sellers. Bears want the channel down from the 24 high to continue, but strong enough reversal up, probably buyers 67 low. So low probability for the bears. It's a bear channel, double top 60, more likely buyers below. Bears trying for a wedge, 60, 68, but the range is really, really tight. I think it's probably better to wait. Bears trying to test down to the low. Is it worth selling the close? I would not. We're setting up a potential bear IOI for tomorrow, which would be a sell signal, but it's also the daily chart sideways, parabolic wedge, 1, 2, 3, 1, 2, 3. I think that we're going down to around these lows for first target, somewhere down here, first leg down. But I don't know if this is the top or if we have to do this for a couple of weeks first. I'm sorry, I was just looking at my trade list, and I was surprised I made more money than I thought I made, and it was because I had a sell limit order working, and I stepped out for a few minutes, came back, didn't realize it. I thought I'd canceled my order. I did not, but ended up making money from it. That's just luck. It could have gone the other way, so I'm usually very careful about checking my order screens in my different accounts before I step out. But sometimes I make a mistake. This one was a mistake where I made money. We're at the bottom of a channel. We're a higher low. The bulls see this as a bull flag, but I would not take the buy. Sometimes you get pretty deep pullbacks. You can see we're getting lower highs, higher lows, and therefore we're in a triangle. It may not be that evident that it's a triangle, but from here we've been getting lower highs, and from here we're getting higher lows. Here, here, here. Maybe on a higher time frame it might be more evident. We had that very strong reversal up the other day, and it looks like this is probably going to be a two-legged pullback, one, pullback two, and we'll try to test up here. 60-minute chart, very quiet and sideways. Still a bull flag. We have a bull trend. We got sideways up, sideways up, sideways, and we have a couple of good bull bars. If we fall below these bull bars, then I think the bears have an argument that they've taken control, but they don't have that yet. And right now, daily chart, we have a bear IOI. Yesterday was outside, today was inside, and today's a bear bar. And we have a parabolic wedge. Computers will look at it different ways. 1, 2, 3, then a double top, failed breakout. So we have different wedge tops. We have an expanding triangle, 1, 2, 3. And for the parabolic wedge part, either 1, 2, and 3 up here, or 1, 2, 3, but a very tight channel, and 3 pushes up. And we're breaking above major resistance, the 2500 big round number, and we're breaking above the August high over here, and the breakout is stalling. Instead of getting a series of strong bull bars, we got 4 sideways bars here, 4 dojis here, and then you got the problem with the bull channel. 1, 2, 3, 4, 5, 5 legs up in a bull channel. A bull channel usually begins to turn over and evolve into a trading range after 3, 4, or 5 pushes up. 3 pushes up, a wedge, 1, 2, 3. Then we've had a 4th and a 5th push up. And so this is a very overbought bull channel. We're stair stepping up. We're getting deep pullbacks after the breakouts. So that means we'll probably pull back down here over the next couple of weeks at a minimum, below this high, maybe into this gap, more likely close to down here. And once we get there, So let's say we sell off down here, support, probably bounce to a lower high, and then get a head and shoulders top, left shoulder, head, and then right shoulder, and 40% chance of a measured move down from there. Weekly chart, way overdone. We had a spike, a pause, and then another spike, and then a pullback, and then the channel, different ways to count it, 1, 2, 3, 4, 5 pushes up, way overdone. And then the single most important thing that I see on any chart is the weekly chart now having 45 weeks without touching the moving average. It got to within a half point here, but did not touch. And that is extremely bullish. They had a technician on Fast Money the other day, maybe it was yesterday, talking about the number of days we have gone without a 5% correction. And he was looking back 30 years. And I forgot how many days he said this was. It was like 300 something. And he says the most that the market has gone in the past 30 years was just a little bit more. And the second most, this is now the second most, he said the third most is not anywhere near this. And what he's basically saying is what I've been saying about the weekly moving average. That in the past 18 years of the E-mini, the longest time the market has ever been above the weekly moving averages here, 2003, we were above the moving average for about 50 bars, and now we've been above for 45 bars. So he's basically saying what I'm saying, that the market is doing something that it rarely ever has done, and while it can continue to do something it has never done forever, that's not the way markets work. They regress toward the mean, and computers sense that the behavior is exceptionally extreme, and the bulls start to take profits, and the bears start to short, and you end up getting a regression toward the mean. In other words, the market starts to behave the way it always behaves, and therefore, this is unsustainable. If you do the math, the market never has to come down to the average price. It can stay above the average price forever. This is a 20-week exponential moving average. I can talk about any average, a 10-week simple moving average, a 200-week simple moving average. You use weighted moving averages. It doesn't matter. The market always comes down to every moving average eventually. And this has been above this particular moving average for an exceptionally long time, and therefore it's unlikely to continue much further. On the monthly chart, I think it's fascinating. We've had 11 bars, every low above the low of the prior bar here. 10 bars with the lows above, but 11 bar bull microchannel, and extremely strong bull trend like this, right, and like this. However, extremely strong bull trends get pullbacks. Again, theoretically, can we get every month from now until eternity where the low is above the low of the prior month? Sure, why not, right? Of course it can happen. Will it happen? Of course not. And therefore you have to look back in the past to find out what extreme behavior is. And 11 bars in a microchannel on the monthly chart is extreme behavior. Just look back over the 18 years of the E-mini and count how many times you have seen an 11 bar microchannel up or down. And I think the number that you'll find is 0, right? I don't know, I'd have to check, but I doubt that the market has ever had an 11 bar bull microchannel on the monthly chart. If it has, it's not had much more than that. And therefore the odds of this continuing are small, or the odds of it continuing much more are very small. Can it go another month or two without falling below the low of the prior bar? Yes. Can it go 5 or 10 months without a pullback? I doubt it. It's never done this, so I doubt that it's going to do more. It's a very tight bull channel, and therefore, when we do correct, the first correction will probably be minor, like a bar or two here. A minor correction on the monthly chart, 2 bars, 3 bars, here, another minor correction. It could still be 10% and still be minor, but on the daily chart, a 10% correction would be 250 points, and it won't look minor. If you have here's the daily chart. If we fall 250 points, that's, way down here. So if we go from here to here, traders are not going to be saying, oh yeah, that's minor. Traders are going to be saying, oh, this might be a bear trend. But it probably won't be a bear trend because the monthly chart is very unlikely to go from 11-bar bull microchannel into a bear trend without first going sideways like this. Here we had to go sideways for 6 weeks or 6 months or so before the bears could get a bear trend. Therefore, the downside risk is not great, but the upside potential over the next several months is small as well. Will we get a 20% correction like Robert Shiller is talking about? I think the chance of it is small without first going sideways. Eventually, of course, we're going to have a 20% correction. We had several corrections here that were about 20%. Is this going to be a 20% correction now? As I said, I think probably not. Probably the best the bears will get is 1, 2, or 3 bars down, and then we'll try to resume up. Here, 1 bar down, went up for a few bars, down, up. So the bears will probably need to do this before they have a reasonable chance at doing that. And therefore, while it's possible we could get a 20% correction at any time, the probability of it is small without the market first going sideways. Anyway, we have a bear IOI on the daily chart. It's possible that in the final 4 minutes we get back to the open, but not likely. And therefore, today will be a bear IOI. But again, it'll be a doji. I said from the outset, even with this big sell-off, that the day would probably close around the open and be a 4th consecutive doji day. And while it has a bear body, it's still, I would still call that a doji day. The tail is more than half the size of the bar. Stop entries today. First bar of the day, we have a bull doji. Yesterday we had big down, big up, big confusion, usually leads to a trading range. The trading range can be tight, it can be broad, but whenever you get big down, big up, you usually get big confusion. We had big down again today. However, we had a gap down and then a bull bar. We had a bear bar with a tail and then a doji bar, bad follow through. We had consecutive bear bars, prominent tails, not strong, and then terrible follow through. Pair of bear bars, again, another reversal. And therefore, this entire sell-off looked like a bear leg and what would become a trading range, and therefore traders started to buy, especially once we had the bull bar on bar 6, and then we reversed up on 13 consecutive bull bars, probably buyers below 14, and probably a channel up. We did channel up. It was a small pullback bull trend. We had a gap, 15 low, 11 high. We have a gap here, and then we tried to get a gap here, and it closed sideways for several hours, but we kept getting lower highs. And the one interesting thing I think about this 40-bar tight range is here we are always in long, but the stop order bulls did not make money. The last time they made money was way back here, bar 20. And from bar 20 through bar bar 64, so 45 bars, the stop order bulls did not make money once. Yet, the stop order bears, scalpers made money here, here, here. So here we are, a trading range and a bull trend, and the stop order bears are making money, and the stop order bulls are not. And that led to this little sell-off late in the day. For stop orders here, the first trade I would take, I think the market went always in short on the close of 2, certainly the close of 3, so it's a stop order sell. And then as far as selling below 10, the always in bears get out above 6, and then they have to sell again below a bear bar because we're still always in short. They sell below 10, but it turned out to be a scalp. I think the bulls could buy either above 6 with a wide stop, maybe below yesterday's low, or above 12, looking for a test back above the 1 low, which we got. And then I would not sell below 14 or 19, even 25 I thought was not a very good stop entry short. And for the bulls, just like the bears had bad follow through all the way down, the bulls get bad follow through with a reversal, bear bars, reversal, bear bars, consecutive bull bars, doji, right? the high one buy signal bars were bad. Bear bar 15 and then bear doji 18. And we stalled around halfway up and the 60-minute moving average, and more importantly, the one low. If you bought above 12, you had a 17-tick rally up to 24. So the bulls were not as confident as they might have been. And then through here, really terrible stop entry trading. As I said, the bears made money 3 times, but the bulls kept getting stymied. You know, if they bought above 30, they got a high 2 at the moving average, but wide the doji buy signal bar. And then a couple legs down here, a big high 2, leg 1, pull back leg 2 with a bull bar, yet another trap. And then here, another high 2, it failed. And then here, we have a wedge bottom, different ways to draw it. 1, 2, 3, or 1, 2, 3, and a decent bull bar. And the bulls made money there. And then the 74 bears, 1, 2, 3, and another lower high. Not a great looking short, but the bears got one more new low. Buy the close, sell the close. I thought it was short on the 1 close or the 2 close. And I said on bar 5 that it was still sell the close, but I was concerned that we were getting down to a price level where the market reversed up 5 times yesterday and reversed up strongly. And therefore selling the 5 close, I thought was dangerous. Had they sold it, they sell more 1 point higher, 2 points higher, and you can see they were eager to get out break even. The 8 low was exactly at the 5 close. The bears tried to go down a little bit more, but it immediately reversed up. Probably always in long 13, so buy the close 13, 14, maybe even 15. Remember, the bears want at least 3 consecutive bear closes. They got 2. And then buy the close, buy the close, buy the close. And now we're at the 60-minute moving average. The rally has bad follow through. We're at 50% pullback. I would not buy closes. And then through here, once the market starts to go sideways, if you're going to be buying closes and selling closes in a tight trading range, you do the opposite. Near the top, you sell bull closes and sell more higher. Near the bottom, you buy bear closes and you buy more lower. And that was all for the rest of the day. Even bar 75, if you bought the close and scaled in, bought more lower, you made money. Limit orders. As I said, you could buy the 1 low. I thought it was reasonable. In fact, I tried to buy. I forgot what I tried. I think I tried to buy 7 ticks below 1, and I tried to buy like a second or two too late, and it bounced. I was trying to buy it because I was expecting a bounce, and after it has the bounce, it did what I thought it was going to do. I pulled my order. If it's coming back down, I don't want to buy it because I was looking for a bounce. We got the bounce, and I don't want to buy again, hoping for another bounce, especially after we have consecutive bear bars, and now it's always in short. Anyway, theoretically, you could buy the 1 low. If I bought it, I would get out on the 2 or 3 close. However, other bulls bought more above a bull bar, 6 or 12, and eventually got out break even. And then down here, probably buyers below 8. I said over here, bar 6, it's a 6-bar bull micro channel in the open, so probably sellers above, but a pretty good looking bull bar in a buy zone, so I personally would not sell that. And I thought buyers below 7, buyers below 9, a bull bar, but it's a low 2 and a bear trend, so I would not buy that. And probably buyers below 6. And if we fell below yesterday's low, probably buyers below, because yesterday was a doji day, so today is probably not going to be a trend day. And since today is probably overlapping most of yesterday's range, if we get down near yesterday's low, bulls will probably buy, and will probably continue to overlap most of yesterday's range. And on the way up, I thought the interesting fact was bar 17, the bears who sold the 14 high got trapped. It did not pull back below the 17 low. And then when we got the micro double bottom, 1820, we're probably going at least a little bit higher. And then bears started selling highs up here. They were not making money here, not making money here, but I thought the rally looked more like a bull leg and what would end up as a trading range day rather than a bull leg that would turn into a small pullback bull trend. It was a small pullback bull trend here. But I mentioned that the bears had a double top bear flag, so they tried to top out here, and then the bulls got to break out and follow through. and then they got a wedge top, 1, 2, 3. We have consecutive tops. We tried to top here, it failed. And then we got another top here. Chances are we'll try to get some kind of reversal. And, we went sideways for the remainder of the day. Through here, it was hard to sell. I did take some shorts. It was easier to buy below bars because we went below bars and we didn't go much above bars. We kept getting lower highs. So you could sell the 26 high, the 28 high, and then the 37 high, a bad looking buy, a bear bar, top of a tight range. And then here, it never went above a critical high to sell. And then here, not a great sell, maybe sell here. Then 59, not a great location to sell, possible little bottom, but a bear bar. And then here, 70, not great. We're probably getting a second leg up, but probably sellers above here or here. And then bulls were buying. They made money below that low, below this low, below this low, and at the end of the day, below that low. Okay, the day is over, and we have a bear eye, but a big tail. I think the odds are we're not going to go much higher. Yesterday was the doji bar. I think it's comparable to this. We got a sell off, and comparable to that. We got a sell off, comparable to this. Got a sell off, went a little bit more up. As you know, I'm holding puts and put spreads, and I will add on if we go up 20 or 30 points from here. But the reason I bought the spreads now is because I'm not sure that we'll go up, and we have a reasonable top. We're in a reasonable, well, let me put it this way, we're in the sell zone, although we do not yet have a reasonable top. We have a parabolic wedge, and sometimes that's the start. And I wanted to sell, I wanted to get short as high as possible. The VXX, I said that buying puts down here when it's in a bear microchannel and all bear bars is probably early, but I wanted to, VXX is the upside down version of the E-mini essentially. Basically it's an ETF. If you want to bet on the E-mini sell off, you can buy the VXX. The E-mini is going up, daily chart, VXX is going down, and it's leveraged so that when it goes up, on a percentage basis, it goes up a lot, like a lot of 10% rallies. Here, we're stair stepping down. It went below this, well, it went below this low, it went back above that low. Went below this low, went back above that low. Went below this low, went back above that low. Went below this low. What do you think is going to happen? Do you think it's going to get back above this low? Of course, the odds are very high that it's going to get above this low. And therefore, it's reasonable to be buying the VXX now, although I have not. If we go sideways and start to get a series of bull bars, I may buy the VXX in addition to buying puts. And again, am I looking for a big bull trend? Well, when's the last time? Let me put up the monthly chart of the VXX. Okay, in the past 10 years, when's the last time the VXX has been in a bull trend? Never, right? In part because the E-mini has been in a bull trend all that time, and in part because, as I have said many times, the VXX is run and maintained by an institution, and they need money to continue to run it, and they get money by taking a little bit of money out of the VXX every day. So even if the stock market were perfectly flat, the VXX would continue to go down. And that's true of any ETF. It doesn't matter what ETF you're talking about. XLF, okay, rallying for all these years. However, it's not rallying as much as the underlying. So if you were to look at the underlying stocks, you'd say, wait a minute, this didn't go up as much as the underlying. And that is because it's an ETF. It's run by a company, and the company makes money every day by taking a little bit out of the ETF. And that's true of all ETFs. So even the spider's an ETF, right? And, if you look at it on a percentage basis, if you bought the spider here versus buying if you bought all 500 stocks in the S&P here, compared to buying the spider, you'd make more money on the S&P. That's because the spider the owners of the spider, the people who own it and maintain it, take profits. They take a little bit of money every day to maintain it. Okay, question. I bought on a stop above bar 20, looking for a 1 point scalp before the market went below bar 20. So he bought above this, looking for a 1 point scalp before it fell below that low. So he's looking for a 1 point profit while risking about 2 points. Okay. Premise was that you had 4 point bulls, 1 tick above my profit target, and a limit and a measured move above, and probably 2 more pushes up. Was the probability high enough for 1 point scalp? Okay, whenever somebody asks me if the probability is high enough for 1 point scalp, I need more information. And, are you willing to scale in if it pulls back? If you are willing to scale in, then the probability goes up a lot, right? So anyway, he bought above bar 20, looking for a 1 point scalp. He put a stop below bar 20, betting that the breakout test would hold. I think that was a reasonable trade. At the time, I said, oh, look what they did with bar 20. They made it just big enough to make it less desirable. They're increasing the risk by increasing the size of the bar. The actual risk was only 3 ticks. You buy 1 tick above 21, and the risk turned out to be 1 tick below, buy 1 tick above 20, and the actual risk was 1 tick below 22. So, you actually risked 3 ticks to make 4 ticks on a bet that was better than 60%. You did not know the actual risk when you put on the trade. But it turned out, once the trade was over, you actually was risking only 3 ticks to make 4 ticks, and the probability was 60% that the market would hit your target. So is the probability high enough above 20 with a stop below 20? I think the probability is high enough if you buy above 20 and you buy more below 20, right? And as far as just buying above 20, I don't know. I was buying below bars, looking for scalps, and not with stops, because I thought the sell-off had bad follow-through, and the rally probably would have bad follow-through as well. But your point about 17 ticks above bar 12 makes sense. There's a magnet up there, and all morning I talked about the magnet at the 1 low. And therefore, if you buy the 20 high, we're probably going 1 tick above the 1 low, and that's 5 ticks above the 20 high, and maybe you'll get the additional tick, which you did. So I think it's an okay scalp. Even if we pull back, like here, worst case is it'll get back to your entry price, and you'll be able to get out without a loss. So I think it was an okay thing to do. Question, if I scalp, should I only scalp in the direction of always in and then add on the next support if it goes against me, or cut it off at 2 points? First of all, if you're scalping and you can see what you believe is the always in direction, I think it's always better to scalp in the direction of always in. Unless the market is always in and it's in a trading range, it starts to form a trading range, then you can start to scalp in both directions. And then about the stop, can you be scalping for 1 point, risking 2 points? In general, that's true, but I usually don't do it that way. I usually look at the chart and decide where a swing stop is. So if I decide I know the always in direction, I then look where the swing stop is, and usually for my initial stop, I use the swing stop. So for example, if I buy the 14 low, instead of risking 2 points, I put a stop below 11. In this particular case, had it fallen below, had I bought the 14 low, I probably would have put an initial stop below 11, but if it started to fall, I probably would have canceled the stop and bought more at the 11 low, betting that we're in the buy zone and we would go up. So one of the difficult things about scalping is it's really, really subjective. And if you study the charts a lot at the end of the day, and you say to yourself, okay, I'm going to get really, really flexible, and the rules become guidelines, and I'm willing to use wide stops and scale in, and I want to concentrate on trading in the direction, the always in direction, you'll discover that there's incredible potential. You can make a lot of money. So that's my thought, that it's always easier to scalp in the direction of the trend, but if you think the market is beginning to evolve into a trading range, and if you can use wide stops like a measured move up from something and scale in, at some point you can start scalping in the opposite direction. So either selling here or here, start selling, and using wide stops and scaling in. Okay, another question. I'm watching my account drain down every day. I'm down to 900 and another $400, and it's blown. I don't know whether to keep trying to hoping to catch on to a big move or cut my losses. The more I lose, the harder it becomes to win. I don't have any more money. Have I reached a tipping point where it becomes hopeless? What should I do? I think it's really hard to trade a $900 account with the E-mini. Do I think it's possible to trade it? I think it's possible to trade it, but I think it's really hard to do it because of one thing, emotion, right? And when you cannot stop thinking about the money, it interferes with every decision. And, then it becomes really, really difficult to trade. One of the stupid things in the market is that they have account size minimums for day trading stocks and ETFs, which is really unfortunate because, if they would get rid of that and you could start day trading the VXX, for example, right? You buy here, for example, you buy there and, 40.83 and you put a stop here, you're risking, 7 ticks. And if you just trade 100 shares, you're risking $7, right? And, I just think it's the dumbest thing in the world that they let people day trade the E-mini and not let them day trade ETFs. I think it makes much more sense to let them day trade both. But, I don't have a voice in all of this. But back to your question, psychologically, I think it's very difficult to trade when on every trade, you're really tense inside, worried that I'm going to lose it. I'm on the verge of blowing my account, and I really need this trade to work. Right? I think it's really hard to, I often make the point that the best way to trade is to trade the I don't care size. Not only the I don't care size, but just I don't care in general, because only then can you be objective and analyze and manage the trades correctly. And if an account is getting next to a minimum size for trading, I think it becomes very, very difficult to trade correctly. For example, what do you do if you buy the 6 high? You put your stop below 6, you're risking about 3 points, it's $150, and all of a sudden, you're risking 15% of your account on a single trade. And that's hard. In general, even really good traders usually only risk 1 or 2% of their money on any one trade. And you can say, well, is that really true? Well, it's really true. They may risk 20% of their account, but 1% of their trading accounts, right? So, if you trade a long time, you start to have a lot of accounts. I have a whole bunch of accounts. I don't even know how many accounts I have, right? So in any one account, I might trade 20% of the account on any one trade, sometimes even more if I'm buying stocks outright. But in terms of my entire portfolio, or if you add up the money in all of my accounts, I don't give it any thought, but I doubt that I ever take a position that adds up to risking more than 2% of my entire account. And so I'm not telling you what you want to hear, but I am telling you that 2 things. First of all, It's hard when your account is near a blown account level, when the account value falls to a level when you can no longer, where the broker will no longer allow you to take trades. It becomes hard not to think about that all the time. It's just in your mind all the time. When the market's closed, you're thinking about it all the time. When the market's open, you're thinking about it all the time. And then another big problem with that is, what's the one thing you're thinking about on every trade? I cannot lose. I got to keep my risk really, really small. And that means you're only thinking about one of three variables. You're thinking about risk, you're not thinking about reward, you're not thinking about probability. And then the final problem is, whenever your account is small, you're so eager to win that if you get a small profit, you take it. And that means you're scalping. And if you're scalping, it's very hard to make money unless you're a very experienced trader. And so you have a combination of factors that make it very difficult. I keep saying that when traders start out, the best thing they should do is try to swing trade, or at least go for 2-point trades, 2 to 4 point trades, or just, always in, always in long, always in short, and then you just hold until the market flips, until it becomes the opposite. And I really think that's the easiest way to make money. I think trying for 1-point scalps, unless you're very experienced, it's a losing strategy, because a 1-point scalp, you're almost always initially risking 2 or 3 points, and that means you have to be winning, 80 or 90% of the time. I've known many traders who win 90% of the time. Anytime someone tells you they win 90% of the time, they're telling you something else as well. They're telling you that they're scalping. The only way you can get a 90% win rate is by going for a lot of small profits. And that also means that their reward is smaller than their risk. And that combination is very difficult to do when you're starting out, and very difficult to do when you have a small account. And therefore, if you're going to be trading with a small account, I think the best thing to do is look for 1 or 2 swing trades a day, and use the appropriate stop. Like buy above 6. If you want, you could put a stop below 6. I would take a second entry buy above 13 and put a stop below 13. Your initial risk is about 3 points, and you just keep your stop here, and you go for, your intention is to get out with at least 2 points and maybe 4 points. And if you bought one tick above 12, it hit your limit order 23 high, but did not fill you. It tried to get there again, did not fill you, tried to get there again, did not fill you. At some point, you just get out, below bear bar, below here, and you'll end up with 2 or 3 points profit instead of 4 points profit. That's what I would do. I would just look for, 1 or 2 trades like that a day, and they're present every day. And, ideally, you want a second entry trade, and you want a signal bar going in the right direction. And I would avoid taking a 1-point scalp. So you buy with above 12 with a stop, 1 tick above. You put a stop below, and then you place a limit order either 2 or 4 points above, maybe 3 points above. And then you go to the gym, or you go to Walmart, or you go someplace. You go for a run, right? Go for a walk, go for a chore. You just go out and come back an hour or 2 later. And I believe over time that you will discover that you're making money. And it sounds simple and it sounds crazy, but I think it's true. You just look for that 1 or 2 trades a day when you have a reasonable chance of a swing, and it's a reasonably good setup, and the risk is not terribly big relative to the reward you're trying to obtain. And if you're always taking 1-point profits, don't. Just place a limit order 2, 3, or 4 points above, for a 2, 3, or 4 point profit, and then just go away and come back, an hour or so later, so that you will not be able to take that 1-point profit, or you will not be able to exit early or get out with a loss. For example, you buy the 12 high, stop down here, don't get out below 14. You get out below 14 and you end up losing a tick on a trade that went up for several points. So anyway, that's my thought about this situation. It's a difficult situation to be in. You know, I'm trying to think if I ever blew an account, 30 years ago. I know I added money to accounts. I don't think that I ever blew an account. But when you're adding money to an account, and you're starting out, you're adding money so that you don't blow the account. But I may have blown an account at one point or another. I don't think that I did, but I might have. All right. Again, another mostly trading range day. The odds are high, probably 80% or more, that we're going to pull back below this August high before we go much higher, and therefore it's reasonable to be going short above this high. But for me to go short, I'd rather do it with puts or put spreads, because we could stay up here for a month or more before we come down. And for the puts or put spreads, I would be looking out in January. Do I think we'll come down below this high before January? Yes, but I want to give myself enough time so that I don't have to put the spreads back on. If I buy October, for example, it's only a month. I still think we'll be down below this high before the October puts expire, but since I don't want to be putting them on, exiting them before expiration, putting them on again, exiting before November, then before December, I'm just going out to January, and and then I don't have to think much about it. Plus, I can add on if we go up, 20 points more from where I put them on. I put them on somewhere in here. I forgot which day, but somewhere in here I put them on. Okay. Hope everybody has a good night.